Okay, let's dive in. We are looking today at the current market, which has been doing some really surprising things, hasn't it? And maybe what's coming next.
Yeah, definitely surprising. And we're digging into a specific piece for this, an article from Lucas Downey over at MoneyFlows.com. It's dated June 5, 2025.
Right, and the title really caught my eye. Forced Flows and the Blowoff.
Sets the stage, doesn't it? So, our goal here really is to unpack the arguments the data Lucas presents, look at recent moves, history, and this idea of a potential blow-off top.
And surprising feels like the right word, especially thinking about May. You know, the old saying about May.
Absolutely. Sell in May and go away.
Yeah, well, 2025 didn't get the memo, apparently.
Not at all. The article kicks off with this key stat.
Yeah.
The S&P 500, it gained 6.2% just in May 2025.
6.2% in May. Wow, that's huge.
It really is, and the source gives context. It's the best May for the S&P since 1990, a 35-year record for May.
Okay, so forget sell in May this year. Does the article dig into why? And like what a big May like this might mean going forward?
It does, yeah. It looks at the history of these really strong Mays. The source calls them power thrust Mays. That's when the S&P gains 4% or more in the month.
Power thrust Mays. Yeah.
And they tend to happen after what the article calls a big macro quake, some kind of nasty event.
Ah, okay, so they're not just random. They often follow a shock or a big scare.
That seems to be the pattern they found. Since 1990, it's only happened 6 times where May saw a 4% plus gain. The article highlights the last 3. 2009.
After the financial crisis, right?
Exactly. Then 2020 after the COVID crash. And 2024 when those recession fears were high but didn't quite pan out. So yeah, often after stress.
Interesting pattern. Okay, so they follow tough times, but what about after? Does the super strong May tell us anything about, say, June or July?
Ah, yeah, this is where, according to the source, it gets, quote, juicy.
Juicy. Okay, I'm listening.
Haha, yeah. They say when the S&P gains 4% or more in May, the next 2 months, June and July, tend to see much higher average gains than usual.
Much higher, like noticeably higher.
Oh yeah, significantly. The data in the article shows an average gain of 5.6% for June and July combined after one of these 4% plus Mays.
5.6% combined. Okay, what's typical for June and July?
Typically, the average gain for those 2 months together, looking back since 1990, is just 1.4%.
Wow, so 5.6 versus 1.4, that's
Right.
what? Almost 4 times the average gain?
Exactly. So historically, that strength tends to carry into the summer.
Which suggests, based on this analysis anyway, maybe don't run for the exits just yet.
Right. The source's take is basically enjoy the ride for now, based on that historical pattern. It suggests potential for more near-term upside.
Okay, interesting historical angle. But the article also talks about needing to understand how we got here, right? Looking back a bit.
Yes, absolutely. Perspective is key. It takes us back to just a couple of months ago, early April 2025.
Oh, I remember April.
Yeah.
Felt pretty grim, didn't it? Lots of negativity.
It did. The source points out fear was everywhere. Pundits talking tariffs, inflation surging, wrecked economy. That was the narrative.
Yeah, that sounds about right.
But the author, Lucas, was apparently telling readers the opposite. His advice then was buy into the fear.
Buy the fear. Easier said than done when everyone's panicking. What was his rationale? Just contrarianism?
No, not just gut feeling. It was data-driven, based on their analysis of what they call forced selling events.
Forced selling.
Right. The argument is these panic-driven sell-offs, they aren't logical, they overshoot, and they create the setup for these massive crowd-stunning rallies afterwards.
So seeing opportunity where others saw disaster. How did the data specifically point to that back in April?
Well, this brings in one of their main tools, the Big Money Index, or BMI.
Okay, the BMI.
MoneyFlows tracks this, and the article explains that when the BMI gets really low, like it did during that tariff crash in early April, it dropped below 36. That's historically been a sign that stocks are about to rip higher.
Below 36 in the BMI is the magic number then, like a buy signal in their system.
Seems to be a key level for them. The article doesn't give the exact formula, but it lays out the historical correlation. Since 2014, the lower the BMI goes below that point, the bigger the average forward returns for stocks have tended to be.
I see. So the low BMI reading in April was the data saying, be bullish, even if the headline screamed sell.
Precisely. Using data to counter that widespread fear.
Okay, so that was April. BMI below 36, buy the fear. Where does the article say we are now June 5th? Must be different.
Oh yeah, completely different picture according to the source. We've swung from that extreme fear and low BMI to now approaching what they call the overbought zone.
Overbought. What's the BMI reading now?
The article states it's at 75%, and they use the word overheated to describe it.
75%. Wow. From under 36 to 75 in, what, 2 months? That's a massive swing.
Huge swing, and the author notes that these really violent risk-on surges often do follow those forced selling periods, and they can keep going, pushing things into that overheated territory.
So we've had the fear, the forced selling, the stunning rally. Now we're overheated. This sounds like it's setting up that blow-off top idea you mentioned at the start.
Exactly. That's the next potential phase the analysis is pointing towards. And they have another tool they use to try and pinpoint this, their equity flows chart.
Equity flows. Okay, how does that work? Is it just looking for lots of money flowing in?
Not just lots, but a specific kind of flow. The article says you look for large green waves of unsustainable inflows.
Unsustainable inflows.
Right. Described as unhealthy forced buying periods. They actually contrast this with the current situation, even though the BMI is high at 75%. The article says the recent buying has still been a healthy amount of money chasing stocks. So it hasn't hit that unhealthy, unsustainable peak yet.
Okay, so it's the quality, the nature of the buying, unhealthy, forced, unsustainable, that signals the potential top, not just the volume itself.
That's the idea. And they get even more specific. They define a clear signal, something they call a discrete blow-off top or a forced flow trigger, FFT for short.
FFT. What triggers that?
It's a very specific, rare event in their data. 400 or more inflows registered in a single trading session.
400 inflows in one day. Wow, that's specific. A single day event signals a top.
It's designed as a clear trigger based on their flow metrics, yeah. And they've looked back at the history of these FFTs, identified 12 of them since 2009.
And is there a pattern around them? What happens before one hits?
Yes, a very distinct pattern. The market tends to absolutely rocket higher in the 2 weeks leading up to an FFT signal.
Rockets higher. How much?
The article gives the averages. S&P 500 up 5.6% in those 2 weeks. The S&P Midcap 400 even stronger, up 8.2%. And small caps. S&P small cap up 9.7% on average in the 2 weeks before the FFT.
Whoa, so it's like a final explosive burst higher across the board, especially mid and small caps, and then the signal hits.
That's exactly the picture the analysis paints. It marks what the author calls peak enthusiasm, likely driven by that unsustainable forced buying.
Okay, so that's the run-up to the FFT. What happens after the trigger? I'm guessing the party stops.
You guessed right. According to the source, once that rare FFT hits, quote, the party ends, and stocks tend to fall, on average, for about 3 weeks afterwards.
A 3-week pullback. How severe?
The average loss they cite for the S&P 500 in that 3-week period is Minica 2.5%.
Okay, so not a crash, but a noticeable pullback after that final surge. A fast sprint up, the FFT signal, then a cool down.
That's the historical sequence they've identified around these specific triggers. And the article really emphasizes that understanding this pattern is, quote, a big deal, especially if you're invested in growth stocks.
Why growth stocks in particular? How are they different?
Well, it's about how money flows during those intense periods. The analysis suggests that the popular high-quality growth stocks, the ones getting heavy institutional buying, they often jump magnitudes more than the indices during that final 2-week surge before the FFT.
Okay, so they lead the charge even more dramatically on the way up into that peak. Higher beta, basically.
Exactly. But there's a flip side.
Of course there is. Let me guess, they fall harder too.
Bingo. When the hangover hits, as the article puts it, and the S&P pulls back that average 2.5%, that pullback gets amplified in those same growth stocks. An average 2.5% index dip could mean, a 10% drop, maybe more, for those high flyers.
Ouch. Okay.
That's the way it works, the source says. It implies that amplified volatility up and down around these FFT points is just characteristic for these types of growth stocks under accumulation.
So much bigger swings for growth stocks around this potential FFT event. And where does the author think we are now? Is the FFT here, or is it still potentially coming?
As of the article date, June 5th, the author believes this FFT event, this potential blow-off signal, is still ahead of us.
Still ahead. Okay.
The analysis suggests the conditions are building, the market's overheated, but that specific 400-plus inflow trigger hasn't fired yet. The article also mentions, that they provide other resources like videos and stock lists for their members to track this stuff in real time.
Got it. Okay, so let's just quickly recap the path laid out here. We started in April with extreme fear, low BMI.
Right, the buy the fear moment.
Then this surprisingly huge May rally, best in 35 years, defying the old adage.
The power thrust may,
Now we're in this overheated state, BMI at 75.
approaching the overbought zone.
And the analysis suggests we should be watching for a potential blow-off top, signaled by a specific rare event, the forced flow trigger, or FFT.
Yep, that 400-plus inflow day, which historically marks peak enthusiasm.
And precedes a roughly 3-week pullback, which tends to hit growth stocks harder.
That's the whole narrative arc presented in the article. The key is how they're using these specific data points, the BMI extremes, the FFT definition, to try and navigate these market phases rather than just relying on sentiment.
It's certainly a very data-driven perspective. This has been, well, a really fascinating deep dive into one specific way of looking at the market's journey and what might be next.
It really highlights, I think, how focusing on the underlying flows, where the money is actually going, and having these historically tested signals, it can offer a different perspective than just watching prices or listening to the noise.
Yeah, that distinction they make between healthy buying and that unhealthy forced buying near a peak seems crucial to their thesis.
Absolutely. It's about the character of the buying, not just the level.
Right. So as we wrap up thinking about this analysis from Lucas Downey at MoneyFlows.com from his June 5th article, it makes you think, how might understanding these historical forced flow ideas, and especially this concept of a specific trigger like the FFT potentially marking a peak, how might that change the way you, the listener, think about market highs, about exuberance, and maybe the signals you watch for yourself?
Definitely something to mull over as you navigate these interesting market conditions.